Hello, I'm Harry Driscoll, Senior Research Analyst at Chelsea. I'm joined here today by James Thomson, the Fund Manager of the Rathbone Global Opportunities Fund, which has been on Chelsea's core selection for a number of years and also features in our Easy ISA portfolios. James, perhaps to start, you could tell our audience a little bit about your fund and also your investment process.
Well, I've been running Rathbone Global Opportunities Fund for the last 10 years. There have been ups and downs, certainly, when I've been managing the fund, but we've delivered some good returns over the long term, about a 235% return over the last 10 years. It's a global equity fund. We're looking to invest in undiscovered, under the radar, or out-of-favor growth companies. And I'm looking to invest outside of the mainstream. I'm trying to unearth interesting ideas that aren't in every other fund manager's portfolio. I'm looking for companies that are creative, employing some innovation into their businesses and shaking up their industry, whether that's Rightmove in the UK property market, advertising properties, or ASOS, the online fashion retailer, or Amazon, the online giant for everything else in our lives, Visa, the credit and debit card company that we're using every day, or a railroad company in the southern United States that's playing into a growing railroad theme, moving goods from Mexico into the United States. So it's all about unearthing these interesting ideas. I have no specific restrictions on where I can invest. I have no rules about countries, sectors, or sizes. I want balance and diversity in the fund, but I've got a free rein to go anywhere I need to find it.
The fund has a global remit, yet you don't invest directly in emerging market equities. Could you explain why that is?
I don't invest in emerging market equities because I don't think I'm the man to be doing it. I think it requires an expertise, ideally specialist on-the-ground analysts and fund managers in these emerging market countries who can really get access to the best quality information, which I don't think I can get sitting in London. So I think if you want direct emerging markets exposure, you're better going to a dedicated emerging markets fund manager. I think it's always good to set back on, stick to what you're good at. Stick to areas of the market that you know well and where there's a level playing field between you and other investors, and that's what keeps me in developed markets.
Back in 2008, you tweaked your investment process slightly and added a defensive bucket of stocks. Could you explain the impact that has had on the performance of the fund in both rising and falling markets?
Well, you remember 2008 was that terrible year of the financial crisis where stock markets around the world fell very sharply. And that really was actually an epiphany moment for me as a fund manager. I came out of that crisis and realized that I could either go down one of two roads. Either I could accept that that was a once-in-a-lifetime event, or I could use that as an opportunity to evolve my investment process and add in a defensive bucket of holdings into the portfolio, which will act as a weatherproofing scheme for the fund, allowing it to navigate through choppier economic times. And that's the road I went down. I added this weatherproofing element, defensive, reliable growth companies that can allow the fund to navigate through more difficult times. It's my view over the next decade that it's going to be slower than normal economic growth, choppier environment for investors. So you need a core element of holdings in the fund which aren't as economically sensitive. So in reality, what's that done to the fund? Well, it's reduced the volatility of the fund. This was a pretty adrenaline-filled fund in its former years. Now it's much more of a core fund. We've probably taken out the tops and the tails, so it won't perform as well in those raging bull markets, but it also will protect investors more in bear markets where we pull back. And so it's really just a fund that allows you to sleep a bit better at night.
At the end of last year, you spoke at an investment event hosted by Chelsea. At the time, you said you were bearish on China and had an underweight in both banks and miners. You also said that the fund had a significant holding in cash. Could you explain how the positioning has changed since then?
Quite materially. So I said earlier that I don't have any direct exposure to China, but everything in the world has indirect exposure to China, and we need to think about who is the most vulnerable to that. My concerns about China are significant. There are dangerous imbalances in China. Just let me give you one statistic. about 47% of their GDP comes from investment to GDP. If you look at other countries in the world, like the UK or the US, that number is 15%. Even if you look at other emerging markets, say India, that's only 37 or 38% of their economy is investment. And investment is building infrastructure, building new manufacturing facilities, investing in their economy. So that number is too high, and it needs to rebalance over time towards consumption, similar to the Western world. The problem is that is an awkward transition, and I think that China is going to go through a period of much slower growth in order to get there. So I need to be careful about how the fund is positioned, because it's my view that the last 10 years has been about emerging market growth. I think the next 10 years it's going to be developed markets. The US, the UK, and even some of our disappointing cousins in Europe might actually do quite well over the next decade.
Given what you've just said, can you explain which geographic region you have most conviction in at the moment?
Really, over the last 6 months, where we've put our cash is into the US, into US equity holdings, mid-cap and large-cap companies, primarily exposed to more economically sensitive areas, because it's our belief that the US is undergoing a renaissance period. So we've increased our holdings in the consumer area, online retail companies, industrial businesses, shale oil and gas companies that are benefiting from the energy revolution in the United States. And so I think this is going to be an interesting area for outperformance over the years ahead, and we've taken our US weighting to the highest in the fund's history.
James, thank you very much for your time today.
Thank you, Harry.